Hey everyone, it's Rob Kientz with goldsilverpros.com. It is Tuesday, January 26, 2021, and I've got more for you on the NSFR and the LBMA and the compliance with net stable funding requirements of Basel III. And it seems like this saga is never going to end. We've got an update on what the timelines could be revised to based upon another document that we found on the internet. And we've got some concerns over the coming stimulus package and what that means. We're going to dive into those details for you. And lastly, we're going to give you an update on the conference we're running this Thursday. Let's go ahead and get started. So the first thing that we wanted to go through was a new document I found on PwC's website. PwC is one of the big four accounting firms that does work across the world for lots of companies and regulators. And they have issued an update on UK delays timeline for some of these reforms related to Basel III requirements. We're going to go through this document, and then we're going to dive even deeper into how the UK is worried about the amount of regulation coming due in 2021 and how they want to push back their compliance with some of this, including the NSFR, until January 2022 to allow for more time for comment and planning. So let's get into this document. Now, if you guys have not watched my previous videos on this, I've had 3 videos on LBMA, the COMEX, and Basel III. We thought we had it solved. We thought as of June 28th of this year, 2021, that the LBMA would come under fire for Basel III requirements for net stable funding ratio because they're an unallocated gold market and they would need 85% backing for that gold market because it's considered a derivative by Basel III standards. Well, it turns out that while the LBMA is panicking this may come due on June 28th, the UK is maybe delaying their implementation of this till January 2022. We'll get into it. So this statement sets out the implementation date of UK's investment firms prudential regime, IFPR. It's what UK is calling their version of Basel III compliance, and version of CRR2, which will be delayed from June 2021 to the 1st January 2022. CRR2, as we will see in this paper, is what contains the NSFR requirement, the net stable funding ratio requirement of Basel III, that would apply seemingly to London's unallocated OTC gold market and the LBMA. It says HMNT and the PRA have stated that the implementation timeline for the further round of prudential reforms for banks, known as Basel 3.1 or more commonly Basel 4, will be unaffected, and their previous statement on the topic still stands. So we will look at that statement. So there was a statement put out April 2nd of 2020 from HM Treasury and the Prudential Regulation Authority on the implementation of Basel 3.1. HM Treasury and the Prudential Regulation Authority welcome the announcement made on 27th March by the group of central bank governors and heads of supervision, delaying the implementation of Basel 3.1 standards by a year. This will provide operational capacity for banks and supervisors to respond to the immediate financial stability priorities from the impact of the virus. We remain committed to the full, timely, and consistent implementation of Basel 3.1 while we work together towards a UK implementation timetable that is consistent with a 1-year delay. I previously had reported on this 1-year delay because I saw it on a website, one of the regulators' website in the UK. But it conflicts with what the LBMA had said about the June 28th date of 2021. So we had to do, of course, further research. Let's go back to the initial announcement. What does this mean? At the EU level, not at the UK level, but the EU, the European Union level, both the IFPR and CRR2 will be implemented in June of 2021 as planned. That would be the June 28, 2021 date for NSFR, but that's for the European Union, not the UK. The IFPR creates a new prudential regime for investment firms, and CRR2 implements a range of Basel Committee agreed standards, such as net stable funding ratio, right here. That's CRR2, net stable funding ratio, in addition to leverage ratio and standardized approach for counterparty credit risk. The UK authorities have committed to implement a UK version of both of these regulations, and the government is legislating through the Financial Services Bill to give the FCA and PRA powers to implement IFPR and CRR2 respectively. So in other words, they're going to duplicate the CRR2, which is part of Basel requirements for net stable funding ratio, which is the one we're concerned with, but they're going to do a UK version. The UK, and this is the key bullet point right here, the UK authorities have, however, decided to delay the implementation due to industry feedback on the volume of regulatory change in 2021. It may also have proved challenging to pass a financial services bill in time to meet the original June 2021 deadline. In other words, they're worried about getting the regulation out and then being able to comply with it by June of this year, which is just about 5 months away. The regulators are expected to publish consultation papers of their implementation of the IFPR and CRR2 in the coming months. Next steps down here in this red section of the document by PwC, as they're reporting, the FCA and PRA are expected to publish respective consultations on the UK's implementation of the IFPR and the CRR2 in the coming months. The UK IFPR and version of CRR2 will be implemented on the 1st of January 2022. So Britain, or the UK, is reporting they're not doing CRR2, which contains the net stable funding ratio right here, until the 1st of January 2022. So it does look like, after all, the original citation I had, I think in the second video, that the UK wouldn't be doing this until the beginning of 2022 is correct. They're not doing it on June 28, 2021, like the European Union is, as documented by PwC. And you'll see it here as well on the regulator's website in the UK. For the 1st of January 2021, the UK's onshore CRR will take effect. That's not the one with the net stable funding ratio. What do firms need to do? It says down here, both the IFPR and CRR2 are complex pieces of regulation, meaning firms should use the extra time wisely rather than pausing implementation programs. The extent to which the regulators in the UK seek to diverge from the substance of the EU's version of the IFPR and CRR2 will only be clear once the regulators' consultations are published, meaning they're going to do consultations this year, publish them, and then afterwards, the UK is going to do the net stable funding ratio regulation. A degree of divergence is, however, expected, meaning firms and entities of both UK and EU will need to manage this. Meaning, if there's a UK firm doing business in the EU or an EU firm doing business in the UK, they'll have to manage the difference in timelines. Of course, more pressure would come on the UK firm, which is expected to comply by January 1st, 2022, than will on the EU firm, which has more time to comply in the UK than it does in the EU. So in other words, UK firms will probably end up having more trouble because the EU firms are expected to comply by June 28th of this year. If that's not more confusing, let's go deeper into the news releases by the British government. Joint statement on the implementation of prudential reforms and the Financial Services Bill. As the Financial Services Bill continues its progress through Parliament, the Treasury, the FCA, and the PRA consider it appropriate to update industry on planned timelines for introducing the UK's investment firms' prudential regime and implementation of those Basel III reforms, which make up the UK equivalent to the outstanding elements of the EU's second capital requirements regulation. That's the CRR2. So we go back to what that is. That's CRR2, capital requirements legislation, which includes net stable funding ratio, is also spelled out as the second capital requirements regulation. So second CRR, which includes net stable funding ratio. Okay, so as far as the LBMA goes, I think they just got bailed out to the 1st of January 2022. Let's continue with the announcement. We have decided to target an implementation date of the 1st of January 2022 for these two regimes. This follows feedback from the industry in relation to these specific proposals in response to the most recent regulatory initiatives grid. We'll show you that in a moment, where industry raised concerns about the general volume of regulatory reform in 2021. The Treasury will ensure the relevant secondary legislation is in place in good time, and the regulators will endeavor to provide the industry with as much sight on the final rules as possible, so on and so forth. So back in November 20th, 16, they released this on the UK government's website, which basically said we're going to delay CRR2, which includes net stable funding ratio. And in November, PwC picked up on that and issued the same. So now I've got two sources, two legitimate sources, the government itself in Britain and PwC, the accounting firm that's involved with the government, on when they're going to implement the net stable funding ratio. It is January 1st, 2022. All right, got that update. Now, let's go to the regulatory initiatives grid. This is the grid of research that was done that caused the UK to say, we're not ready for NSFR and the rest of CRR2 in 2021. And we're not going to go through all of this, but we're going to go through to the part where it talks about CRR2. And then we're going to go to where it talks about LIBOR, because I've covered LIBOR before in previous videos a couple months ago and what that means, the transition from LIBOR to SOFR. So let's do a quick search for CRR. And we're going to get down to this grid. So let me pop back. And this is the part that talks about implementing CRR2, which has net stable funding ratio. Originally, they were going to comply, if you look up here at the dates, by June of 2021. That was the expectation, but they've delayed it because they went through this exercise to get this done by June 28th. And through this exercise, this is the research, they decided to issue the statement where they're delaying it. So I just wanted to point out, this is the document they're talking about here when they're saying we did all this research, this is the grid, and then decided to pause it back to January 1st, 2022. I'm going through that grid, but I want to go through the grid because it also talks about LIBOR. So there is a neat table in here. Transition from LIBOR to OIS-based risk-free rate. Consultation paper planned by the end of December 2020. But the LIBOR, if we can get down to, actually, I think it's up here. We're going to get to the calendar. Okay, so transition from LIBOR, as you see here, I'm highlighting it, for the end of 2021. So at the end of this year, Britain's going to change from the LIBOR to the OIS, basically floating rate or derivative determined interest rate. The LIBOR, for those of you who may not have followed my LIBOR SOFR video, the LIBOR is London Interbank Offering Rate. It is the rate that banks lend to each other, which broke down in the last financial crisis. Banks didn't trust each other at the last financial crisis, so they stopped doing market determined LIBOR rates, and then a bunch of banks got together and just made them up. They said, well, if we were going to lend to each other, we'll do this rate. It was not a scientific calculation. And there was also a big investigation on how the LIBOR was rigged. So there were recommendations on changing this. So they're transitioning from LIBOR, the old system, the rigged system, to a new system. In the US, that is the SOFR rate. I've covered this in a previous video. In Britain, it's the OIS. In any case, they're going to go to a derivative driven rate, which is going to be determined by derivative markets, which means it can be manipulated. But it's going to be manipulated in a way that's hard for people to understand it's manipulated, because instead of having 6 or 7 banks just making it up where it's easy to determine that it's been manipulated, it's going to be manipulated through the derivatives market. And where have we seen manipulation in the derivatives market before? Oh, I don't know. Treasuries, gold, silver, the entire commodities complex. So Britain's going to go from this LIBOR system to their OIS derivative system at the end of 2021. So I would expect the end of 2021, the interest rate market in Britain to be more volatile and highly unstable, which means the debt markets in Britain and the US, when they transition to SOFR, are going to become more highly unstable. Just wanted to throw that in because it's part of this overall research that they're doing into Basel requirements and the changing from LIBOR. The Basel requirements changing from LIBOR to these derivative determined interest rates are all a part of the last financial crash we had in 2008, 2009. They still have not implemented them because I don't think they can. Look how complex this market is, to where they have to spend so much time trying to figure out what they're going to do and keep delaying the dates. This affects the debt market, the interest rate market. It's going to affect currencies, and it's going to affect the gold market and any other derivative traded market that falls under those Basel III requirements. So wanted to give you guys that update. Again, I don't think it's going to be June 28th this year in which the LBMA derivative gold market has to comply, because in 2 places on the government website, they're saying January 1, and PwC is saying January 1, 2022. And I know this has been back and forth now over 4 videos, but again, this is everybody offering their opinions, the EU, the Fed, the UK, and none of them can agree on timelines. And that's because these are highly complex instruments in which they have to be very careful not to crash the system when they start implementing these regulations. What does all of this mean to you? It means that things are extremely fragile right now, and there's a lot of risk in the system. And they're trying to be very diplomatic in saying that by issuing these official press releases and statements. But if you look beneath the surface, there's a lot of turbulence. They're really unsure about this transition. In this paper, they talked about how much regulation in 2021. In other words, if you tighten up the system by too much in 2021, it could crash or cause unintended consequences. That's the plain English translation of what this is telling us. We have to do it more slowly, more slowly. Why? Because they went through this regulatory initiatives grid and they looked at every single requirement, put it on the calendar, looked at the requirements, freaked out about the CRR, and came back and issued a statement and said, yeah, we got to push it back by 6-7 months. And then PwC came back and said, oh yeah, this is, they have to do this because they want to make sure and get it right. Well, no, it's because they can't comply with it right now. So they're buying themselves more time. Okay, I've beaten this horse completely to death, but I wanted to give you the updated date because I know everybody's been wanting to know this. So we're going to give you that. Now I wanted to go towards the economy, and you can start to see the propaganda come out specifically on Reuters here, talking about the stimulus plan. And if we don't get the stimulus plan, it could cause problems in markets. In other words, the market is addicted to monetary crack. And we're going to go over two different articles in Reuters, one January 26th and one January 25th that talks about this. So on the 26th, Reuters released an article that says the Biden stimulus plan could boost the U.S. output by 5% over 3 years, the IMF. This is modern monetary theory. This is saying if we just print, we'll boost the GDP. Preliminary estimates show U.S. President Joe Biden's proposed $1.9 trillion economic stimulus package could boost U.S. economic output by 5% over the next 3 years, the chief economist at the International Monetary Fund said on Tuesday. Going down here, said the IMF had not calculated the impact of the proposed stimulus package on the global economy, but they're just looking at the U.S. And it says, we have forecast that this can raise output in the U.S. by 5% over 3 years, she said, cautioning that the estimates were still preliminary. In other words, if it doesn't work out that way, that's my get out of jail free card because it's preliminary. But we're going to print this in the media so everybody says, oh yeah, do the stimulus so we can have growth. Because if you don't have growth, the system crashes. It is monetary methadone, okay? The IMF predicts the U.S. economy will expand by just 2.5% in 2022. So it's going to start by 2.5%, but over the next 3 years by 5%. That's what they're saying. How do the U.S. politicians react to this? U.S. Senate Majority Leader Chuck Schumer said late on Monday that he and his fellow Democrats may try to pass much of Biden's coronavirus relief bill using a process that would bypass a Republican filibuster and allow it to pass with a majority vote. Now, they're tying the stimulus to the problems they're having dealing with the other issue, which is the virus and the shutdowns. They want to get people vaccinated so they can release the shutdowns. I'll let you guys talk about vaccination. I'm not going to cover the vaccinations. You guys can talk about that in the comments. But I want to get to this other article released in Reuters the day before. And there's a little bit more fear mongering. Oh my gosh, the market is unstable because we don't have the stimulus. Stocks rise on earnings boost. U.S. Treasury yields lower. Well, why are U.S. Treasury yields lower? Global stocks rose on Tuesday, helped by strong earnings updates in the U.S. But U.S. Treasury yields hovered close to 3-week lows on concerns about potential roadblocks to President Joe Biden's planned $1.9 trillion stimulus. Oh no, if we don't get the monetary methadone, the system's going to crash. Does that tell you what stage of the system we're in? We're in the euphoria, the hockey stick, right before the crack up boom. We're getting closer to the crack up boom that Austrian economists talk about when you're on this fiat money type of system. And what is standing in the way of us getting this monetary methadone passed? U.S. lawmakers agreed that getting the virus vaccine to Americans should be priority, even as they locked horns over the size of the pandemic relief package. Chuck Schumer nevertheless warned the relief package may be 4 to 6 weeks away. Disagreements have meant months of indecision in the U.S., where new cases have been above 175,000 a day. Millions of people are out of work. So says the authorities. If you trust those numbers, that's up to you. So in other words, what they're saying is, guys, we got to get the virus situation handled first and get the vaccines out before you can get your money. It's like it's almost a threat to the market, so that they're threatening the market to say, let's get the virus stuff done first, and then we'll give you the free money. You can either look at it as a carrot or a stick or both at the same time. They're going to hit you with the stick, meaning you're not going to get the money unless you take it, or maybe they're trying to entice you into taking it by saying, then we'll give you the money. I think, that's politics at its finest. And it speaks to how dubious Congress is, because if they wanted to work on both at the same time, obviously they could. They're not stupid people, but this is the way they do it. They release this through the media to scare people into getting what they want. They want people to take the vaccination so that they can then give you the money. That's the carrot and the stick. All right, now turning to Zero Hedge, we have a little bit more bearish article by Zero Hedge on a Bank of America news release. It says, Bank of America warns take profits ahead of coming correction. Bank of America's, I'm going to quote from Zero Hedge. I don't have a link to Bank of America's report, but Zero Hedge is reporting this, so we're just going to go ahead and report it. Bank of America's technical analyst Stephen Suttmeyer published a note on Monday titled, Correction Risk Increases Moving into February. Point out that as January comes to an end, seasonality risk in February may suggest it's now time to take some profits or other defensive measures as several market indices achieve upside counts projected by the 2020 election breakouts. Suttmeyer said S&P 500 probed the upside target of 3885, 3830, 3885 from the bullish triangle, blah, 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 technical analysis. And the technician has a yearly bullish review of SPX 4000. Still, in the short term, he envisions a tactical downside risk developing from complacent put calls and a lack of bullish confirmation, so on and so forth. Bank of America is saying we're going to have a short-term correction. What is Reuters saying? We need to get stimulus passed. They know the market's going to correct unless they can get stimulus passed. They're working on it, but before you can get stimulus passed, you got to take the vaccine. That's what they want. Aha. Okay, now on to the real world and getting away from the idiots in politics. We have the S&P CoreLogic Case Schiller 20-city composite home price index. The reason I want to bring this to you guys is because they just recently published additional data on home prices. So this is looking back through November 2020, so it's a couple-month-old data, but they're showing how much house and price index has increased over time. So the one-year return, so from January 2020 to January 2021, it's increased 9.08%. You can see here. So the index now is printing at a 238.48. It's almost 10% over a year. But wait until you see the year-to-date numbers. The year-to-date numbers by themselves are almost identical, meaning in the month of January, it's gone up by 9%. So if you're looking to buy a house, it's a bubble asset, clearly. You can see the long-term trend over 10 years and over 5 years, but those are 5% returns. 1 year is 9%, but year-to-date in 1 month, it's 9%. In other words, we're starting to reach that parabolic phase of the housing market, according to Case Schiller, looking at 20 popular cities for home prices, because in 1 month, it's risen as much as it has the past year and double what the 10-year trend is. You're starting to see the first phase into the bubble, the hockey stick formation in the housing market. I'm warning you here first because we follow this data and we're starting to see the bubble. We've seen the bubble in the stock market. Now we're seeing the bubble in the housing market as well. And that's going to affect people because we've been talking about inflation, inflation, inflation. Inflation is affecting consumer goods. It's affecting transportation, like we talked about yesterday, and getting goods from overseas to the US so that we can have them. That's going to cause increased prices. And we're starting to see that inflation also in the housing market. Now, if you hold a house right now and you plan on selling in the short term, this could be bullish for you. Everybody else is trying to find housing. This could price them out of the housing market. But again, we're in that next leg of the bubble of real estate. So we have covered a ton of information. Let's recap. We covered the information updating us that the UK plans to comply with the NSFR, Net Stable Funding requirements of Basel III by January 1, 2022, not June of this year. That appears to give the derivative market, including the LBMA's unallocated gold market, some additional time to comply with the 85% margin requirements or 85% backing requirements of that. So they could flood that system with additional cash on the balance sheets. They could try to source physical gold, all those things I talked about in the last presentation that they could do. They just got 6 more months to do it. Want to put that out there. We've got legitimate sources straight from the government and PwC. So now we know what the date is. And again, this date seems to be moving all over the place. And that's indicative of risk in the system and the fact they know if they tighten too much in 2021 and try to rein in this market too much, we could have a crash, or that could cause unintended consequences. That's really the big takeaway from that data. We looked at how the Congress is threatening not to pass a stimulus bill unless we can get the vaccine bill in place first, carrot and the stick. And we got Bank of America warning that we're overheated, we're going to have a correction. And because we're overheated, we may have a correction. You want to get that stimulus in, or else the system could correct or even crash at that point. And that's what happens when you're on monetary methadone, because you're in a fiat-based bubble system. All right. So recapping all of the news of the day, that's an absolute lot to hit you guys with. Hope you guys are absorbing that. Wanted to give you that before we go to the conference. Yes, I'm going to be inviting you once again to Solutions 2021, where we have now over 600 people attending. I fully expect to hit at least 800 to 1,000. Our goal is actually 1,500, but if we get to 1,000, that'll be a fabulous conference. That's going to be January 28th, this Thursday, 2 days from now, from 11 a.m. to 9 p.m. Central Standard Time. I'm actually going to open the gates about an hour early so people can get in and mill about and look at the sponsor booth. So you can come in 10 a.m. Central Standard Time. When you go to this website, which is hoppin.com, which is the platform, /events/solutions-2021, you will see that you can register for free here. It's a free ticket for you to get in and see the conference. And like I said, we'll open an hour early so you guys can come in and mill about and see what's going on. We'll start the official presentations at 11 a.m. Central Standard Time. When you come to this website, it will put the time in your time zone. So don't worry if you're trying to translate the time. Hopin platform does that for you automatically, depending on where you're connecting to the internet from. But we have a lot planned for you at this conference. We have Fernando Aguirre talking about surviving a currency crisis. He is a survivor of Argentina, 2000 currency crisis. He will talk about his experience, because if we're going to have a fiat dollar crisis and a euro crisis and a pound crisis, that we want to talk about what to do and get prepared ahead of time. Again, Dr. Scott Craig from Silver Independent talking about monetary history in the U.S. to help us prepare. Andy Schechtman from Miles Franklin to talk about silver demand responding to political chaos. And I'm sure he's going to want to talk about the LBMA and the NSFR requirements as well. We've been talking about that a little offline. He's really excited about getting an update there. We've got James Anderson from SD Bullion talking about gold and silver. Bitcoin, Kerry Von Hess is going to talk to us about Bitcoin, Tether, and all of his massive amount of research that he's been doing on that market. He covers it better than anybody, so I just brought him to the conference to talk about it. If you're thinking of going into the cryptos as a safe haven, he's going to provide a lot of data which will help you make that risk assessment for your own portfolio. I'll be updating my Gold Ponzi Unraveling Trouble in Paradise issue with the LBMA and COMEX, and talking about the Great Reset and what is going to happen to the next round of currencies. You do not want to miss that. We're going to be talking with Alex Newman about sorting the noise to find good information. That's good investment information and good general information to educate yourself so you can make right decisions. Chris Vermeulen of Technical Traders to talk about managing financial risk using technical analysis. Chris Marcus of Arcadia Economics is going to be there talking about what to do when the dollar dies. Jerry Huang, CFO of Impact Silver and Principal Gemini Capital, will be talking mining stocks. If you want to know how to value mining stocks, when to get into mining stocks, some examples of mining stocks, Jerry's the guy, smartest guy I know in the finance space in the mining stocks. And lastly, but not least, actually not last, is now Daisy Luther from the Organic Prepper, talking about how to prepare outside the financial, what other things we can do to prepare for the coming currency crisis. I've been talking the last week about we've had inflation in food prices. I showed you today how we have inflation in housing prices. How do you deal with that? Daisy's going to provide us some practical advice. And sorry, last but not least, is CEO of Glint Pay, Jason Cozens, talking to us about how to store your gold safely. If you're going to get into physical gold, where do you want to store it? At home and safe storage? And he has a solution for you on that, because this is Solutions 2021. We're not only going to talk about the issues that we have, we're going to talk about potential solutions to help you get through those issues. And not to be unmentioned, but the after hours party from 6 to 8 p.m. after the conference, we'll all get together, have a nice time, talking with each other, giving our experiences, asking questions of the presenters. I will be there. It'll be a lot of fun. A lot of people, when they come to conferences, tell me this is the most fun part of it. In fact, our previous conference in August, the Monetary Metal Summit, which we'll run every August of every year, was a lot of fun, and people really like the social interaction aspect of that. So come to the after party. This is Solutions 2021. 2 days left, guys. January 28th, 11 a.m. to 9 p.m. Central Standard Time. Hope this gives you a really good update as to what we are seeing in the derivative gold markets, what we're seeing in inflation, what we're seeing with the coming stimulus package and what they're trying to do with it. And we'll talk more about all of that and a lot more upcoming at the conference this Thursday. I really hope you guys can attend. I think you will have an absolute blast. We had so much fun from the first one. This one's going to be bigger. We've got more people coming to it already. And I think we're just going to have tons of fun. So can't wait to see you guys there. I'm going to do one more report on Wednesday before the conference. We're probably going to live stream that during the day. So be checking my YouTube channel for that. I'll make an announcement on Twitter as well. I want you guys to show up because I'll be answering questions. We'll do a live Q&A tomorrow, sometime Wednesday. I'll announce the time over Twitter. So come to Twitter and come to my YouTube channel for that. And you can see that session. And then it's straight into Thursday, the conference, Solutions 2021, the one you guys asked me for. This is fan-driven, subscriber-driven. I'm bringing it to you to provide you the information that you guys wanted. Don't miss it. It is going to be a ton of fun. Until next time, guys, this is Rob Keens of goldsilverpros.com.